Hello and welcome back to the ROI channel, the channel that's obsessed to the art and science of return on investment and stock analysis today. It's in this second derivative category on the inflation beneficiaries, if you want to call it that. So the hard asset, interest, capital light business model. And we're going to talk about exchanges mainly is the best way to think about this particular silo. Starting with today, a short and simple analysis on Intercontinental Exchange. It is a holding that's available in the publicly listed portfolio. So let's talk about it. Make sure you like and subscribe to the channel, and make sure you like and subscribe the ROI Club on my Substack. There's plenty of free content in there and some very good premium content to boot. Link will be in the description. Disclaimer, talking particular stock today doesn't mean I know what I'm talking about or that my views will change. Can't guarantee any of the information. I'm not a financial advisor, so none of this is to be considered advice. It's just me sharing my opinions, and hopefully you guys get a bit of entertainment value out of it. So doing very well. It's a holding in the portfolio. What I want to point out with this particular company is the following, and that is you're looking at this. If you're looking at this from a cigar butt investment point of view, you'd say the price looks a little bit steep. So you're looking a little bit over a 5%, a little bit under a 5% free cash flow yield expected over the next 12 months. Okay, bear that in mind about some of the points that I'm going to bring up. Solid, steady compounding revenue growth, and a lot of that hits the bottom line. Very solid return on equity. We're going to get into it today. Again, paying 24 times market cap to free cash. If you go back and watch some of the videos that I was doing even 2 years ago, you'd say that looks a bit steep. You better have a good reason as to why you're going to pay that much and underwrite such a multiple. And I still believe that to be true. You better have a good reason. And so I'm going to give my reasons today. Intercontinental, it's a short, simple thesis, really. It's asymmetric in terms of there's really not too much that could go wrong in terms of this stock. The downside would be if the exchange shut down. Okay, they do have other revenue sources. They have brokering. They have different finance options. But that's really the main thesis for why I'm invested in this thing is for its exchange value. Okay, so 5% yield is, or less than 5% yield, 4% yield really today on a free cash flow basis. Is that expensive? What is it cheap? What is it? Well, you're paying 2 to 3 for the likes of the visas, and here you're getting 4. If you can get it at 5, it's probably a good buy. And that sounds very strange coming from my lips, but you've got a better business model that can have a call option to the upside in an inflationary environment. And so let's take a look. Historically, look, if you could get an 8% free cash flow yield on this type of thing, that was last seen years ago, over a decade ago. And so if that were to occur, if we got a flash crash or something like that, I'd be looking to bump up my list, my allocations to these types of businesses for sure. Revenue. So I've just taken the last decade so that we can get a bit of a glimpse at this thing. Revenue up to the right. Okay, so over 3 billion. Now we're doing, over 9 within a decade. Tripling your top line within a decade. Pretty darn good. Free cash flow following suit. And on the rolling axis here, you can see the margins. The margins never, so this orange line here, they never drop below 30. So 30 cents, let's just call it, on every dollar that drops through the top line is going down to the free cash flow. Okay. So then that's cash that's available for the business to use. What are they going to use it on? It's a capital light business model. It's essentially a setup with a lot of computer servers, computers, mainframes, that sort of thing. What would happen tomorrow if they doubled their business through a volatility event and their orders just went through the roof for derivatives and trading and all that sort of stuff? How much extra would they really need to spend in order to accommodate that? And the answer is not much at all, nothing. Bit of extra computing power. And that's the opportunity that these types of businesses represent, because exchanges, clearinghouses, and the like, you're coming into more inflation, which leads historically is associated with a lot of volatility. People need to offset that volatility via insurance in the derivatives market. They need to forward sell, forward buy, all that type of deal. Just simply more trading activity. And so increase in trading volume, increase in revenue, for no extra expense, really. These guys don't have much in the way of growth capex, and you can see that being illustrated in the chart here. Which, remember, after the oil price crash in 2014, we really didn't have an awful lot of either inflation or fairly few volatility events of note until obviously COVID, um, which in this case, I mean, COVID didn't impact the exchange. The only thing that I think might impact the exchange if we went into some really strange, like World War III scenario and exchanges shut down and trading shut down around the world. In which case, we got a lot of other problems to worry about. So here we've got SG&A margin. You can see flat. Okay, there's no real extra cost in running this thing. Return on equity solid, usually double digits, and processing billions and billions of dollars of trading activity. So that's a good thing. It's coming up at its 25th birthday, really, as it is today. They've gone through a series of acquisitions. Started off as a over-the-counter derivatives trading house, which is it's really interesting to see how that Jeff Sprecher has grown this business over time, which is also speaks a lot to the management's ability to compound. And acquiring New York Stock Exchange Euronext was, I think, a really, really, really good move. I think that was a really good move, and so they've been able to really grow their business and the different products on offer. Crypto market does well. These guys, these types of guys, maybe not necessarily Intercontinental, also do well. So that's something that we might want to think about as an indirect beneficiary. I've got a very basic valuation model here. I don't want to get too caught up in the valuation metrics and trying to be too precise with this type of thing, because I'm looking out into the future in a long-term insurance type play that if we get some volatility, all this might be severely understated. And so it's very hard to be accurate in underwriting what I think this business could do. But I know you guys are all going to want to have an idea anyway. So I'm putting a very rough sketch out there. I've done EBITDA and I've done free cash flow estimates. I've assigned historic growth rates to extrapolate it over the next decade. There is, in my opinion, there's a case for this being too conservative. If we get lots of volatility, their orders are going to increase and that's going to drop to the bottom line. But be that as it may, this is what I've done in terms of underwriting the valuation. You can agree or disagree. It's completely up to you. I've used historic means over the last decade as a guide to putting in the growth rates, the valuation terminal multiples, and discounting just at a flat 10. Their weighted average cost of capital is actually less than that. Be that as it may. So if what I've put here is somewhere close to realistic, and I'm not even saying that it is, it would suggest today's valuation is around about $168 fair value. Obviously, you might want a margin of safety. That there is it's showing not a lot of upside from today's stock price of 155 and change. But however, it's predictable. It is an inflation beneficiary. It's an asset. It's a hard asset, not directly, but indirectly in terms of more commodities being traded. Obviously, this company or this business model is going to do very well. So it's not a direct beneficiary like a royalty co, but it's a second derivative play out there that I think is worth mentioning. There's so many ways to win. New products, more volatility, as I said. Their management have been shown to be very good compounders. There's another very interesting aspect to exchanges with regards to providing a truly diversified opportunity for investors. And that is much more the case, in my opinion, with exchanges than there is in the typical index like the S&P 500. It's very US centric, it's very tech, very market cap weighted. And I do not think that that really gives an investor a broad diversification tool in their investment arsenal. Contrast that with exchanges, it's almost the case that the exchange will do better than the underlying indexes because all that trading has to occur on an exchange, if you follow my logic. So I think that exchanges are far more attractive to me. Yes, you have to pay up for them, but there's a place for them in the portfolio. And as such, I have ICE and I also have CME as my major exchange holdings. I would like to expand some of the others. I'm just doing a little bit more work and to see if I can justify underwriting them. So that's that, guys. I hope you enjoy. Like, subscribe, leave me a comment. Make sure you check out the Substack Substack in the description, and I look forward to catching up with you in another video shortly. Take care.